Welcome back to the Your First Home buying series. I'm James Cullen, a local San Francisco realtor. Today we're going to talk about step 3, which is securing financing. And again, we're using this book, Your First Home, as the guidance, the 10 steps to home ownership and beyond. You can grab the book down below, or you can continue to tune in every week as I release these videos. And if the video is already out, it'll have a link so you can keep watching and continuing on. Let's get started. So step number 3 is securing financing. And if you come from a wealthy family or you have wealthy people to reach out to, job done. Next step. But if you're like the majority of America, then you're probably looking to get a loan. Let's talk about some of these options, because first we need to understand what is a mortgage. And a mortgage is a loan that is secured against the property where the bank is going to provide X amount while you put down a down payment. They need to have you with some percentage of a buy-in. And as an agent, we usually like to make sure that somebody is qualified before moving forward, because I would love to live in a $5 million house, but I can't afford that. So if I was to go out there and start searching, then I'm just wasting time. There's no way that I'll be able to afford that. So one of the biggest steps we take before we even get out to view property is securing financing. And that could be in the form of a pre-approval, fully underwritten, or even all cash. Now, if you're in an all cash position, that's fantastic. And sometimes people will borrow against other securities to get a deal done. In general, leverage your money, use a bank, use the lenders, because long term, you're able to borrow the money. And a lot of people focus on that interest rate. That's only one of the factors you want to consider when securing your financing. Let's go ahead and move forward. Now there's 4 basics when it comes to getting a mortgage. That first one is your down payment. And as mentioned before, 20% tends to be the regular that most people talk about, and over different economic cycles, it's been a good number that people can maintain and work with. But there are government-backed or even some local programs in different cities where 3.5% for an FHA or even a 5% down for different conventionals. You're just gonna have property mortgage insurance and maybe some other terms like a higher interest rate or maybe a point that's paid up front. And talk to your lenders about the different products that they're gonna offer. I do also wanna make a quick note about PMI. If that's the only way you can get your deal done or get into home ownership, then it's a great option. It's better than you having to save even more and maybe get outrun by the market where you're only gonna keep chasing it. The second basic is interest rates. Now, interest rates, just like credit card rates or even car loan rates, all that are variable. And one of the biggest factors is interest rates are based on whatever the Fed is charging. So the Fed is charging these large banks a percentage of the money that's gonna be borrowed, and mortgages add on top of that. So in the last 30 years, the average has been about 6.5% to 7%. And we just went through a period where it was 3% or even below in certain credit situations. And it's gonna continue to rise and fluctuate. In the 80s, it was up to 16 or 17%. So pretty much buying a house on a credit card. And you have the option to refi as rates come down. Do keep in mind though, there might be different terms. So make sure you understand before accepting a deal like that. There's 3 quick factors I want you to consider when thinking about interest rate. The first is that the Fed sets the interest rate, or the banks set it based on what the Fed's doing. So you don't have control of that, but if it's the time that you're buying and you can manage the monthlies, you probably want to move forward with that. The second is your credit history. Your credit history is going to impact the type of loan that you can get or the interest rate that is offered to you. It's not something that you can immediately change, but it is something you can change. So you want to consider it if you're not yet ready to buy and you're planning down the road. Work on things that can fix your credit and raise your credit score. And the third thing to keep in mind with interest rates is you are going to be the one selecting the mortgage. So do make sure to get educated about the different products so you pick the one that works best for your needs. That one you do have control of. The third mortgage basic is the term of the loan. Now there's different types of loans, whether it's fixed or adjustable rate, but how long you're gonna pay. 30 years tends to be what most people choose because they want the consistent monthly payment throughout that whole life of the loan. But you could do a 15-year and the mortgage payments will be a little more expensive every month, but you're gonna obviously be done paying your house much sooner. So depending on your financial position or what your long-term goal is, do consider the flexible terms. And the fourth, like I just mentioned, fixed rate versus adjustable rate. Now, depending on where the market's heading with interest rates, an adjustable rate mortgage might be the best option for you. Or if you're planning on only living in a house for maybe 4 to 7 years, then doing a 7/1 ARM or a 10/1 ARM might be, an ARM is adjustable rate mortgage, that might be the best option for you. So worth considering, just understand what's really being paid for. And sometimes the interest rates there will be much lower on a monthly than traditional. So focus on that monthly payment, what makes sense for you and what you can manage and afford. Here are 7 steps to financing a home. The first step, establish a budget. Just like a suitcase when you're going on vacation to somewhere that you know you're gonna bring something back from, you wanna leave a little bit of room. If you pack it full right in the beginning and you get to that destination and you're not able to bring back any shot glasses or mugs or anything, any souvenirs, well, now you've used all your budget. Do your best to figure out what you can afford and then maybe trim it back a little bit on a monthly aspect. Because most importantly, you don't want to just be able to buy the house, you also want to buy the things that make it a home, such as furniture. So set a budget and stick to a budget. Always a good plan, especially in changing markets. You'll have a little more flexibility where you could still get the home you want when it's available. Second step, choose a lender. Now, there's really 2 main types. There's the mortgage broker or in-house mortgage lender. You'll find that mortgage lender is going to be at your current bank or maybe with a big banking institution. And what they're going to offer is all their in-house options. Versus a mortgage broker is the one that goes out there and shops the different banks. And they're going to fight a little harder to get the better rate for you. Or if you're self-employed, they're going to have different options versus an in-house bank like US Bank, Wells Fargo may only have, well, the options they give, and it might not have the same amount of flexibility for somebody in a different position. And just like finding an agent being a major step in this process, finding the right lender to work with is also. It's a good idea to get references or referrals from people you work with, or even from the agents themselves, because if they're familiar with the person, then they can work together, and they've probably experienced some troubles along the way in the past, so they already know what to forecast and to get you to the finish line of winning your home. The third step is apply for a loan and get a pre-approval. Now, like I mentioned before, this is that piece of paper that you give to your agent and it says, cool, we know what our budget is, we know what we can afford, we know where to start looking in our search. Now, it may help you understand what types of homes are available in the neighborhoods you want to buy, because again, you want to keep price, location, and condition in mind, because you might be able to get in the location you want, but the condition's terrible of the home. Maybe that's what you're looking for, but probably not. You probably want to live in it if this is your first home. Some of the stuff you're going to need to prepare: if you are self-employed, a 1099, and if you work for somebody, a W-2. They're going to want proof of employment and income. And you may want to consider your debts that you have too, because they're going to be asking for that. Step 4 is consider your mortgage options. Do you want less of a down payment? Do you want a shorter term to pay off the house and the equity sooner? Looking for an adjustable where today you can afford one thing and you know you're getting bonus down the line. That's a bit more risky, but do consider your different mortgage options. It's one of the main reasons I tend to work with mortgage brokers, because they could shop different options in many different banks all in one place. And they fight hard to get your business, because unlike banks, you're already in their ecosystem. They just need to maintain you. They don't need to do too much. Step 5, you found a home and you've started to write offers because you had that pre-approval ready to go. You've gone through the process and submitted an offer. Then it's got accepted. Congratulations. Now, you want to submit that purchase agreement to the lender so they could get to work, because it's just the beginning of that process of you owning the home and our chance to do due diligence. A good portion of that contract will dictate what's happening inside of your loan. And so the agent should already be working very closely with your lender to make sure you're both in agreement as you're moving forward with your purchase agreement. Step 6, get an appraisal done. Now, if you're getting a loan, an appraisal will already be ordered. You may need to pay for it, so do consider that as one of those costs. But escrow will now officially be open and you're moving towards the finish line of you owning the home in trade for the contract and money agreement that you've now signed. Exciting times, but there's a lot of work still ahead. Step 7, obtain official funding. So this is the remaining amount of money that you're gonna pay for it. At the very beginning of a contract, there's usually an earnest money that needs to be upfront. Locally here in San Francisco, it tends to be about 3% of the purchase price. So if it's $1 million, you're looking at having $30,000 upfront, showing that we are serious moving forward. Not just a contract signed, but there's now money on the line. So we want to move forward if the seller has accepted our offer. The remaining amount, that 3%, will go towards your down payment. So if you're doing 20% down, then the remaining 17% will be paid forward. So this is your chance to finalize all the costs included for you to get those keys. So this has been step 3 of the home buying process, and it's a very important process because having the right lender can make things move smoothly and forward. And just like a good realtor, they should be explaining the next steps in the process so you are comfortable with the finance piece. I work very closely with all the lenders that work with my clients so we can all be aligned and get to a closing date on time so you can move into your home the minute escrow is closed. If you're planning on buying a house here in San Francisco, of course, don't hesitate to reach out. That's what I do day in and day out. And if you're looking for anywhere else, you can still reach out. I do know agents in different cities and different towns, especially here in California. The next step is really a process of elimination. You want to set up your criteria because there's so many options in real estate, and it's really just a process of eliminating what you won't live with and what you will live with. So tune into that next video, and I'll see you soon.